All right, here's my quick question to you. How does delta normalize with implied volatility?
How does delta well, you gave me a little hint earlier today when you said it really doesn't matter what the implied volatility is.
No, it doesn't matter what the underlying is.
Oh.
So I want to bring this back to something. So Victor was chatting it up a few minutes ago, right?
Mm-hmm.
And Victor was talking about AMC. Now, I know Victor cares about, for some reason, the CEO of AMC, which I couldn't even tell you what his name was.
Nor could I.
And I don't think you would know either.
No.
Nor any other, not very many other companies for that matter.
Only the Mary Powell. Go ahead.
Where he gets hung up on who the CEO is, I couldn't care less about anything about AMC other than it's a $5 stock with, I don't know, 400% weekly implied
volatility. Depending on what month you're looking at, sure. Yeah, it doesn't matter.
400% weekly implied volatility, 250% monthly volatility.
Sure.
And the argument here is, and this is what I didn't really get a chance to explain to Victor, hopefully he's watching this right now, is that if you took any other stock that was $5, any other stock, any other CEO, any other stock, any other company, whatever it is, it doesn't matter who the CEO is, it doesn't matter who the board is, it doesn't matter what their business model is, it doesn't matter how crazy anybody there is, just knowing the implied volatility, we can tell you everything about that stock.
Sure.
Because that's what efficient markets do.
You couldn't tell me the CEO's name.
I don't care about the CEO's name. Here's the thing. If you gave me another stock with another $5 stock with the exact same volatility as AMC, do you know where the options would be priced?
Say it one more time.
If you take two $5 stocks.
Yeah, they'd be the same.
XYZ and AMC.
Yeah.
And they both had 200% implied volatility.
Yeah.
The options would be exactly the same.
Right.
Exactly. There'd be absolutely no difference. So nobody cares. The volatility normalizes everything because it basically tells you everything you need to know. For context around our strangle trades, what is the difference in credit that we will collect based on the level of implied volatility in that particular underlying? And what we're going to show you is that regardless of the underlying, as long as the level of volatility is the same, everything else is going to be exactly the same. That's how we normalize everything. That's how we know that what we do here is legit, because we don't care what the underlying name is. We don't care what the story is behind it. Volatility, because of the size of the marketplace, tells us exactly what the stock's going to do and what it's expected to do. That's up or down. 2005 to present, SPY strangles 16 and 30 deltas. Compared to the average premium collected in all environments, the average premium collected in varying IV environments. Then we compared to other underlying's current premium collection. Note in this segment, premium is recorded as the following in order to normalize the changes in stock price. Okay, so we just gave you the little formula there. Premium equals credit over stock price. Since 2005, the average VIX was 19. On the next slide, we'll show you what the average credit for 16 and 30 delta strangles in the SPY looks like over time. As the VIX goes up, the credit you receive on the strangle as a percentage of SPY increases proportionally. The credit on a 30 delta strangle was exactly twice that of a 16 delta, regardless of where the VIX was. Just showing you what we call as everything is symmetrical. We've always used the term symmetrical. Here's just evidence of kind of everything being symmetrical. Right now, the VIX is between 10 and 20, right? So 16 delta strangles as a percent of stock price, you collect about 8%. If volatility was to double and go to 30, 32, the strangles as a percent of stock price would be 1.7.
And that's why we like high implied volatility. It's the same product, you're getting paid more to take the risk.
Yeah, right now, just imagine if volatility gets back into the 20s, then it's going to be almost 4 times as expensive. The options are. That's why what we do is so much more interesting when volatility is higher. When comparing the credits of a 16 delta strangle in the same expiration cycle across various underlyings, we find that they scale 1-to-1 on the implied volatility of the underlying. So the underlyings themselves don't matter when the credit is priced, only the implied volatility, the delta, and the expiration cycle. So when we compared the SPY to NVIDIA, Amazon, Tesla, gold, and TLT, the current June credit as a percent of the stock price was only a multiple of the implied volatility. So the fact that NVIDIA has a CEO that's very different from a broad-based index like the SPY or gold or TLT or a CEO like Tesla,
the pricing is the same.
Market don't care. Market only cares about what the implied volatility is.
That's the fact, Jack.
That is the fact. For a specific delta in expiration, the credit you receive as a percent of the stock price will only be determined by implied volatility, and the underlying itself is irrelevant. For example, with TLT and SPY, just like I explained before with AMC and anything else, for TLT and SPY having the same implied volatility, their credits are identical. This is true for any two underlyings with the same IV. So when people get all hung up on everything, it's all about, like we've said from the day one, it's all about liquidity and implied volatility. Think about takeaways here. We are product indifferent when it comes to putting on positions, because when comparing two trades with the same delta and the same expiration cycle, the credit received will be determined by the implied volatility. We trade different underlyings so that we get exposure to higher levels of implied volatility and diversification via price correlation, but not because the stock itself actually matters. This goes very counter to anything you've ever heard about trading. I mean, that's why Tasty's different.